Ladies and gentlemen, welcome to the London School of Economics and Political Science. My name is Minouche Shafik, and I'm the director of the LSE, and I am delighted to see all of you here today in the Old Theatre. Today, we will hear the inaugural PGIM Lecture Series in honor of Professor Charles Goodhart. Charles is an eminent economist who was appointed to the Norman Scott Sosno Chair of Banking and Finance at the LSE in 1985. In theory, Charles retired in 2002 and became an emeritus professor. But the reality is that he is a model to all of us of how to remain intellectually vibrant throughout life. He was elected a Fellow of the British Academy in 1990 and awarded a CBE in 1997 for services to monetary economics. He's written widely on a range of issues in monetary policy, especially central banking and macroeconomics, and is famously the author of Goodhart's Law, which states that any observed statistical regularity will tend to collapse once pressure is placed on it for control purposes. Or, in more common parlance, when a measure becomes a target, it ceases to be a good measure because everyone will game it. Charles put his knowledge of monetary policy into practice over many years, establishing the Financial Markets Group here at the LSE and serving as a monetary economist at the Bank of England for 17 years. He also served in Hong Kong on the advisory committee to the Hong Kong Monetary Authority. And when the Bank of England's Monetary Policy Committee was created, he was appointed one of the first independent members, establishing a long tradition whereby the Monetary Policy Committee of the Bank of England has never had less than 2 people from the London School of Economics on it. So tonight's speaker couldn't be a more perfect tribute to Charles's life and career in finance, economics, and monetary policy. Delivering the inaugural Charles Goodhart Lecture is Lawrence Summers, who by any possible measure is one of the most prominent economists and economic policymakers in the world today. Larry is the Charles W. Eliot University Professor and the Wheel Director of the Mossavar Rahmani Center for Business and Government and President Emeritus of Harvard University. During the past 3 decades, he has served in a series of senior policy positions in Washington, including the 71st Secretary of the Treasury for President Clinton, Director of the National Economic Council for President Obama, and Vice President of Development Economics and Chief Economist at the World Bank, when I worked for him on the World Development Report in 1992, which was the first time the World Bank laid out its policy views on the environment. I remember Larry used to start most meetings at the World Bank by saying, if you're going to say something with which no one could possibly disagree, don't bother. It set the stage for conversations that were challenging and productive, and I have no doubt we will have such a conversation today. Larry received a bachelor's degree from MIT in 1975 and was awarded a PhD from Harvard in 1982. I could spend the next hour reporting on the many accolades he has received. One of the youngest individuals to get tenure at Harvard, first social scientist to receive the annual Alan T. Waterman Award of the National Science Foundation, recipient of the John Clark Medal Reward for the most outstanding American economist under 40, and so on and so on. But since no one here could possibly disagree with the fact that Larry Summers merits accolades, I won't bother. So, before turning to the man himself, just a few housekeeping items for the Twitter users today. The hashtag is #LSE Goodhart. This evening's event will be recorded and provided as a podcast afterwards. There is a photographer who will be taking photographs. Let us know if you don't want to be included. And as usual, after the lecture, there will be time for questions and answers. And I will call on you in the usual way if you have a question. So, with that, please join me in welcoming Larry Summers to the LSE. Oh! Forgive me, I missed a beat. Before turning to Larry Summers, please join me in welcoming Charles Goodhart, who would like to say a few words. Charles.
In fact, I didn't first arrive at LSE in 1985. I arrived in 1965. So it's been nearly 6 decades that I've had connections with LSE. And during that time, I've had wonderful interactions with colleagues and friends at LSE over the many years, past, present, and even perhaps for a few more years in the future. And I'm deeply honored by having this lecture series in my name. I'd particularly like to thank Dimitri Bayanos and JP Ziegrond for arranging it. I'd very much like to thank PGIM and in the background, my great friend Sushil Wadhwani for arranging the funding of the lectures. And of course, I am deeply honored to have Larry Summers as the first speaker. As the director said, there couldn't be possibly any better choice. Larry is brilliant, forceful, policy-oriented. He changes the way that we live and think. And he is perfect in any way. But I do recall that he had the advantage of coming from a remarkable family. I was a friend at one stage of his father, Bob Summers. And of course, Larry is related quite closely to Paul Samuelson. So he has a sort of a ancestral linkage that to economics that none of the rest of us can possibly match. I have to say that the occasion this evening is slightly bittersweet for me. It's somewhat akin to attending your own funeral before you're actually dead. So I hope that, Larry, under these circumstances, you will cut any eulogies to the bone and get straight stuck into the analysis, which we're all waiting to hear. So with great pleasure, I pass over to you, Larry.
Minouche and Charles, thank you for those very kind words. I'm reminded of what Lyndon Johnson used to say when he was introduced very generously. I wish my parents had been here for that. My father would have appreciated it, and my mother would have believed it. And I am glad to be back at the LSE. My association is much less close, but almost as long as Charles' association. Mine began in 1967 when I was a 13-year-old boy and my father was on sabbatical at the LSE, and we spent a very happy year in London, during which I often visited the LSE. I had an opportunity about 20 years after that to renew my acquaintance with the LSE when, thanks to the wonderful hospitality of Richard Laird, who I see sitting right here, I had an opportunity to have my own sabbatical at the LSE in association with his Center for Labor Economics and partial association with the Center for Financial Markets. And I'm glad to be with you, Minouche. I have warm memories of our time working together at the World Bank, and never before or since were economic forecasts prepared so assiduously or so skillfully as you did. And I'm delighted to have the chance to speak at a lecture honoring my friend Charles Goodhart. Charles has always seemed to me to be an exemplar of what it means to be a practical macroeconomist. And I confess that, unlike in the case of philosophy or theoretical physics, I have never been sure what the point was of being an impractical macroeconomist. Charles always worked on important issues. He never cited the model as the source of a conclusion without making an argument that a reasonable person could follow or assess. He always considered objections to whatever proposition he was putting forth and marshaled many different kinds of evidence. And as the example of Goodhart's law suggests, he communicates clearly and memorably. I might take this moment to say that partially in honor of Charles, a few months ago, I coined a proposition that I called Summer's corollary to Goodhart's law, though I suspect I was the first, not the first to invent this particular proposition. That was that when a target ceases to be used as a target, it goes back to having predictive relevance. Has anybody observed the money stock figures in the United States and the subsequent rate of inflation in the United States? I think there's something to be learned there. And perhaps most importantly, it's a privilege to be speaking at a lecture series named after Charles, because we've both been engaged in recent years in reflection on broad macro events at a time scale that is greater than the cyclical and that is shorter than the generational. And it's that time span that I will have in mind in my remarks tonight. I chose the title some months ago, Secular Stagnation or Secular Stagflation, because I didn't know what exactly I was going to want to say, but I thought that I could usefully fit it under that title. And I've now figured out what I want to say. I'm going to assert and develop 4 propositions. First, I'm going to review and suggest the continuing relevance of the theory of secular stagnation as it came to be renewed in the middle part of the last decade. Second, I want to discuss how, almost overnight, a secularly stagnant American economy was transformed into an economy that was somewhere between overheated and on fire. Third, I will argue that neither the Fed nor most forecasters have come to terms with what is likely to be necessary to restore price stability in the years ahead. This failure to be realistic about what is necessary to restore price stability raises the risk that the task will not be completely accomplished and that we will, for some meaningful interval, experience what might be called secular stagflation. Fourth, I suggest more tentatively that recent indications that the US economy may go into recession without egregious rises in interest rates suggests that secular stagnation may yet return. Finally, I will conclude by reflecting a little bit on the relevant policy challenges. Secular stagnation. Where did the idea of renewing Alvin Hansen's concept that industrialized economies faced the challenge of a chronic excess of desired saving over desired investment come from? For me, it came from two observations in the middle of the last decade. The first was that while interest rates were zero, budget deficits were very large, asset prices and wealth effects were very strong, growth in the aftermath of the financial crisis was nonetheless very sluggish. And in association with that very sluggish growth, and entirely contrary to anything that I had even thought about in graduate school in the 1970s, central banks seemed to have difficulty in hitting their low 2% inflation targets from below. The second motivating observation was a rather dark view of US business cycle history that at that time went something like this. We were suffering extremely slow growth, even though the economy was far short of potential. Prior to that, we had suffered through the great financial crisis. Prior to that, we had had a reasonably robust economy propelled by a massive housing bubble and a vast erosion of credit standards. Prior to that, we had suffered a slow recovery from the recession induced by the tech and stock market bubble of 2000. Prior to that, we had enjoyed reasonably robust growth supported by the wealth effect emerging from that tech bubble. In other words, it seemed to me then and seems to me today reasonable to assert that during the 20-year period from 1997 to 2017, there were essentially no moments, perhaps there was a stray quarter or two, when it could reasonably have been asserted that the United States economy was growing in a healthy way alongside sustainable and healthy financial conditions. These two observations taken together, and the second observation is really an extension backwards of the first observation. If one is a well-trained macroeconomist in traditional macroeconomics, have a natural interpretation. Suppose something had happened that pushed the IS curve well backwards and to the left, or in regular language, suppose that there was a very large desired propensity to save relative to the desired propensity to invest. What then would you expect to see? You would expect to see slow growth, limited demand, very low equilibrium levels of interest rates. Savings flow into existing rather than new assets, meaning high asset prices, substantial attraction to leverage because of the low interest rates. In short, one would expect to see exactly what we did see over that 20-year period. And so Hanson's original idea about changes in the propensity to save relative to the propensity to invest, it seemed to me fit rather well the facts. Now, the problem with that argument, as I first thought about it, was that, well, it's nice to say, well, if there was a change in the savings propensity relative to the investment propensity, if there was a backward shift in the IS curve, then all the things that we see would have happened. But was there some legitimate set of reasons for believing that in fact had happened? Rather to my surprise, as this question was examined by a range of people, there were changes in plausible estimates of changes in savings and investment propensity with particular causes that fully could have accounted for what we just observed. Increased uncertainty tends to raise the desire to save for the future and tends to discourage new physical investments. Efficiencies in the use of capital, exemplified by my cell phone, by e-commerce, by the fact that the number of square feet a law firm requires per lawyer fell in half during the first 15 years of the 21st century. All of the fact that my son's generation is much keener in living in apartments in cities rather than larger houses in suburbs. All of this suggests a decline in propensities to invest. Similarly, higher increased inequality suggests increases in the propensity to save, and much slower labor force growth and population growth suggests reductions in the demand for housing and reductions in the demand for new equipment and new office space. And so it seemed to me that at that point, it was plausible to suppose that we could see the declines in reasons for the decline in the propensity to save and the propensity to invest. That it was closer to right to think of very low interest rates set by central banks and very expansionary fiscal policies pursued by governments as endogenous responses to that chronic excess of saving over investment than it was to see them as autonomous policy choices that were shaping events. And it was my strong policy view through 2019 that a key priority for macroeconomic policy was to facilitate the absorption of saving, in part through the promotion of investment, in part, as Keynes had argued during the Second World War, through the more expanded provision of social insurance that would reduce the need for individual and private saving. And so it was my view that economies would need to think very differently about fiscal policy than they had in the past. To put the point in easy kind of language, if the Maastricht criterion of 60% debt relative to GDP was appropriate in a world of 9% nominal interest rates and 5% real interest rates, some very different criterion was appropriate in a world of 2% nominal interest rates and negative real interest rates. I'm not going to say anything about 2020, which I think was sui generis as economic time, if not financial time, was in a sense suspended as everybody stayed home. But I could not have imagined what would happen at the end of 2020 and at the beginning of 2021. I had been confident as one can be in macroeconomics, which isn't all that confident, of this secular stagnation idea. I thought there was a chronic excess of desired saving over desired investment of 3% or 5%, some number in that range of GDP, which led to awkwardly low interest rates, inflated asset prices, and enlarged fiscal policies as full employment was sought. Here's what happened in the United States during 2021. At the beginning of the year, it was reasonable to forecast that the United States would have, during the year, an average GDP gap on the order of 2 to 3%. People could argue that how much had potential GDP been reduced by COVID, what was the right way to think about a range of issues, but no one would have come up with a number very different than 2 to 3% of GDP as the gap. We embarked on a fiscal stimulus program of between 13 and 14% of GDP. 13 to 14% of GDP in fiscal stimulus, accommodated by zero interest rates, substantial central bank expansion, and supplemented by a substantial increase in balance sheets as a consequence of the spending that had been deferred from 2020, was by far the largest expansionary policy that had been pursued since the Second World War, and was approximately 60% as large as the expansionary policy that was pursued during the Second World War, with none of the rationing or other constraints that were applied during the Second World War. It seemed to me that on any plausible view about the multiplier, I have been accustomed to thinking of fiscal multipliers when the interest rate was constant as being 1.5. But even if they were only 1/2, 13 or 14% of GDP in fiscal stimulus against a 2% GDP gap seemed to me overwhelmingly likely to produce an overheating of the economy. Of course, I didn't focus on the question of supply shocks because I felt that even if there were no supply shocks, there was enormous overheating tendency. And if there were supply shocks, and they were important, that would simply magnify the inflationary impulse. I was fortified in my view by two historical comparisons. One was the LBJ guns and butter period. Charles remarked that I come from a family of economists, and it's true. I was on average 13 years old, and I confess, for better or for worse, I kind of was following the inflation statistics in those days. And so I watched with great interest as the inflation rate went from having a 1 handle in 1966 to a 6 handle in 1969. And the Vietnam War impulse, depending again on just how you measure it, could not be said to have been more than 2% of GDP. The other example I looked to, because I had been personally involved, was the Obama stimulus after the great financial crisis. It is generally agreed that that stimulus was smaller than would have been ideal. There are raging disagreements where I'm an interested party as to whether it was too small because economists like me gave bad advice on how big it should be, or whether it was too small because we gave advice that it should be as big as was possible politically, and the politics were limited. You can guess which side of that argument I'm on, but for the purpose of this conversation, it doesn't really matter very much. For the purpose of this conversation, what's important is that the Obama stimulus was somewhat smaller than the projected GDP gap during the year in which it was being applied. In contrast, the 2020 stimulus was 6 times as large as the projected GDP gap. There is no one, not anywhere, who believes that the Obama stimulus should have been 3 times as large as it was, let alone 6 times as large as it was. So it seemed to me that the likelihood was that stimulus of this magnitude would drive very rapid nominal GDP growth, as it did. Nominal GDP growth during 2021 was 11.6%. And that with 11.6% nominal GDP growth, it was hard to imagine inflation not being out of the range of target levels of inflation. And so it was. Yes, it is true, as many pointed out, that not all of that stimulus was going to be spent during 2021, and indeed some of that stimulus is being spent today. I think that's even worse, because the more the stimulus was delayed, the more likely it was to come at a moment when the economy was overheating. To this day, I do not understand why this view was not more widely shared, since rather than being a synthetic insight, it seemed to me to be an application of textbook macroeconomics. Here is one clue, and it goes to the nice things that I was saying about Charles and his unwillingness to slavishly adhere to models. Several weeks ago, I asked a research assistant to do a very straightforward exercise in whatever way he thought best. I asked him to take the so-called FERBUS model, which is the macroeconometric model that the Fed uses uses as its workhorse tool. It's a large dynamic stochastic general equilibrium model that can be solved with rational expectations or in alternative ways. And I asked him to do the following exercise. Increase the budget deficit by 10% of GDP for, you choose the interval, 5 to 10 years, and tell me what the model says the inflation rate will be at the end of the exercise. He chose 7 years, and he reported that the inflation rate was increased by 80 basis points, according to the model. I concluded that I had learned more about the model from this exercise than I had learned about the working of the American economy. There is a core statistical problem. It's actually a more elementary proposition than Goodhart's law. If you statistically examine a constant quantity, you will conclude that nothing has a very large effect on it. Think about running a regression with the y variable being a constant. That is essentially the reality of the last 40 years. And so all kinds of statistical exercises have concluded that whatever you did, inflation wasn't going to be that different from 2 or 3%. That is, I think, the core reason why this fairly egregious error was made. Does this mean that secular stagnation ideas are no longer relevant today? No. No more than the coming of World War II meant that secular stagnation ideas were not the right theory for understanding the economy prior to the coming of World War II. Where are we today? What is likely to be necessary if inflation is going to come down? Since I have scorned complicated statistical models, the only thing that's left for me to do is a back-of-the-envelope calculation. So let me ask you to join with me in considering a back-of-the-envelope calculation. There are going to be 3 necessary parameters in my back-of-the-envelope calculation. How much do we need to bring inflation down? At one level, the answer is inflation's running at close to 9%, and we need to bring it down to 2%. But surely Team Transitory has many good arguments, and surely there is a reason to think that a variety of commodity price inflation may revert, that bottlenecks will eventually be solved, that when those bottlenecks are solved, the shifts of demand will, on balance, operate in the direction of reducing inflation. Alan Blinder and Paul Krugman have both estimated that we have 2% of inflation that we need to reduce. That seems to me, looking at the figures on wage inflation, to be too low a figure. So I'm going to assume that we need to reduce inflation by 2.5%. I think that estimate is as likely to be too low as it is to be too high. Probably I actually think it's a little more likely to be too low than to be too high. But I want to be conservative in reaching a conclusion. The second parameter we have to estimate to do a back-of-the-envelope calculation is how much does inflation come down when you induce economic slack. This is the parameter that was very frequently discussed in the 1970s and 1980s, but has largely fallen out of economic discourse as inflation reduction in industrial countries has ceased to be an important issue. The prevailing view in the late 1970s, and particularly in the post-Volcker period, is that that sacrifice ratio is 2, or is in the neighborhood of 2. That is, if you have 1 year with unemployment 2 percentage points above the neutral rate, you will reduce the inflation rate by 1%. Now, it is generally and widely believed that the Phillips curve has become far flatter over time. If that is true, that would say that the sacrifice ratio has become larger. Because I want to be relatively conservative in this calculation, I'm going to use a sacrifice ratio of 2. The third parameter we need to gauge, we can calculate from what I've already said, that in order to bring down inflation, we are going to need to have 5-point years of unemployment above the non-accelerating or neutral rate of unemployment. And the question then is, what is that neutral rate of unemployment? If one looks at estimates prepared prior to COVID and the 2021 stimulus, a prevailing estimate would have been that the neutral rate of unemployment was 4%. However, models that built in that assumption failed entirely to predict the 3+ percentage point acceleration in wage inflation that took place during 2021. Moreover, the so-called beverage curve, a staple of my work with Richard during my days at the Center for Labor Economics, relating unemployment and vacancies, appears to have shifted outwards to a very substantial extent. If one asks, looking at how that curve has appeared over the last year, what unemployment rate would be necessary to bring vacancies down to their 2019 level, the answer is 6+%. I'm going to assume that the neutral rate of unemployment is 5%. I think you could make a case that for the next 2 years, that number's too high. I think you can actually make an equally good case on the basis of recent wage inflation and on the basis of the beverage curve that that number is too low. What does this say? We need 5 point years of unemployment above 5% to contain inflation. In other words, we need 2 years of 7.5% unemployment, or 5 years of 6% unemployment, or if you could imagine it couldn't really happen, 1 year of 10% unemployment. These are numbers that are remarkably discouraging relative to the Federal Reserve's view in its most recent forecast at the moment when it was seen as making a major commitment to restrictive policy, that the unemployment rate would rise to 4.1% briefly as the inflation rate declined to 2%. Indeed, of 19 voting members of the Federal Open Market Committee who provided forecasts, the highest estimate of where unemployment would reach was 4.5%. Now you can judge my calculation, and there are plenty of questions you could ask about it, but the gap between 7.5% unemployment for 2 years and 4.1% unemployment for 1 year is, I think it is fair to say, immense. What does this mean for secular stagflation? It raises the question when I say I will pay any price for a worldwide trip, but that I expect to pay $400, how committed I am to take that world, around the world trip. Is our central bank or other central banks prepared to do what is necessary to stabilize inflation if something like what I have calculated is necessary? That is a question on which each market observer will have to make their own judgment. But the possibility does, I think, need to be recognized, as in the 1970s, that inflation may be brought down and then allowed to increase, and it may take more than one effort at stabilization before stabilization is achieved. My fourth observation, more briefly. What does all this mean for monetary policy? What I have said so far is that if successful inflation stabilization is going to be achieved, it is likely to require economic slack substantially beyond what is currently contemplated. How restrictive does that mean policy will have to be? How high does that mean interest rates will will have to be increased. Here, I think it is a serious mistake to render confident judgment. The approach taken by many in the central banking community of saying that they believe the neutral rate of interest is 2.5% or 2.6%, and their intention is to raise interest rates to 3% or 3.5%, therefore they are moving to restrictive policy, is, I would submit, a classic example of assume a can opener economics. The idea that the neutral rate of interest is 2.5% is premised on the idea that the inflation rate is 2%, and precisely as what is at issue is whether policy is going to be sufficiently restrictive to achieve a 2% inflation rate. So the proper criterion does not involve a comparison of a nominal interest rate with some estimate of a neutral rate. The proper comparison involves a real interest rate with some estimate of a neutral real interest rate. Here, I would simply record that the plans, announced plans of the central bank seem to be associated with quite substantial declines in stock prices, quite substantial declines in consumer confidence, quite substantial upwards assessments of recession probabilities, which brings me back to where I started. Perhaps we are now living in a world with a very low neutral real rate of interest, and so benchmarks that we have traditionally thought of may be quite inappropriate. In other words, it may not be necessary to raise interest rates to extremely high levels to induce quite substantial degrees of economic slack. What does this suggest with respect to policy? The first lesson is entirely not helpful. It's that it would be better to be starting from a different starting point, and that being in this starting point makes the problem immensely difficult. The second is that it is hard enough to make policy in an environment with this much uncertainty without constraining oneself further with a need to behave in conformity with the statements that have been made in the past. And so it seems to me the return to humility, the abandonment of forward guidance as a policy tool is entirely appropriate, and that the appropriate judgments will involve the use of judgment, but I believe that it is likely to be necessary to make much more difficult choices than the policy process has yet contemplated between acceptance of slack and acceptance of sustained above target inflation. And in that way, I fear we are going to have elements of both secular stagnation and secular stagflation. Thank you very much.
Larry, your talk reminds me of that T.S. Eliot poem about you start off on the journey and you end up where you started again. You delivered both stagnation and stagflation, which is a pretty pessimistic prognosis. But maybe I'll just start with a question, and then I'm going to turn to the audience, and I'll take questions in groups of threes, and there'll be mics to come around. At the end, your comment about the neutral rate implied that over the long term, the big forces that have delivered secular stagnation, demography, debt, structural changes in the economy, it felt like you were saying in the long run those will prevail, that we are in a new world. I mean, I remember when I was at the Bank of England, they found that the cuneiform tablets from Babylon, the implicit interest rate that you could derive from them was about 5%. And pretty much since the beginning of human time, the interest rate has been about 5%. But it feels like we're in a new world. Is that what you're saying, that this is really a fundamental break from that history?
There was a Harvard economic history graduate student who I'm embarrassed to say I'm not recalling his name accurately enough to try to pronounce it, but who believes that, didn't go back as far as you did, but he put together a data set that began in 1200 and took us to this moment, and he believes it's been downwards trending since 1200 in terms of the interest rate. I think that the forces that are operative seem to me to be mostly of a kind that have led to a 25-year decline in neutral real rates. Most of them seem to me to be continuing. The best arguments against that proposition actually are, I think, in Charles' book with Professor Pradhan, and they are the suggestion that that the demography will go the other way, that we're going to have more and more aged dissavers, and so you're going to lose that demographic link with saving. Maybe. I think as people live longer and retire shorter, and retire at the same time, you're going to be getting more saving as the population ages due to life expectancy. I also think the solo effect, the effect of a slowdown in the labor force on investment, is likely to be very large relative to what's happening with respect to saving. And the other set of issues involve globalization, where Lucas, Rachel, and I looked very carefully at the flow of capital into the industrial world from the developing world. And our conclusion is that while the US current account surplus and deficit changed a lot, and the Japanese changed, and Europe changed, the aggregate flow to the industrial world, or from the industrial world, was never very big in either direction and didn't fluctuate very much at all over the last 30 years, which tells me that there's not much scope for deglobalization to be a major factor interfering with this downward trend in real interest rates, whereas the technology around the relative price of capital goods and all of that seems to me something that's likely to persist. So my current instinct is to think that these forces will be with us for quite some time to come.
Okay, let me open it up to the audience. If you could raise your hand, I'll get a mic to you. I'll take questions in groups of 3, if I may. Let's start with Martin. And then, if you could introduce yourself, and then Hugh. And then I think I saw one in the back there. Yeah.
So I'm Martin Wolf. There are many questions, but the one that I was thinking about at the end is, could you argue that it is plausible that secular stagnation will work at the end of all this when we get done? Because this is a massive confidence shock. If you're right, there'll be several years of completely unexpected inflation, followed by completely unexpected unemployment, which almost certainly will have large political consequences. And none of this was supposed to happen because it wasn't in the model. And the last institutions we still trusted are going to be completely busted flushes. In this, no sensible business will invest, and secular stagnation will be much worse.
Okay, Hugh. Maybe, Martin, if you could pass it up front there, that'd be great.
Thank you. Great lecture, Larry. How some investors are Hugh Van Steenis, I apologize. Some investors think, or at least are hoping, that the 1946-49 post-war parallel is stronger, where inflation came from 18 down to 2%. How persuaded are you by that post-war experience?
Okay, gentleman in the back there. Yeah, if you could raise your hand, I'll get the mic to you, and then I'll come back to Larry. And I'll do another round at the top of the auditorium next.
Hello, I'm Andrew Kenningham. I work for a company called Capital Economics. I'd just be interested in your reflections on the extent to which you think the inflationary impulse in the US is similar in Europe, particularly given that you put so much emphasis on the huge fiscal stimulus in the US, which wasn't really matched over here.
Three very good questions. On Europe versus the United States, I think that they're actually quite different. I think in the United States, it is much more demand-driven. And in Europe, because of natural gas, because of energy dependence, rather than essentially owning your own energy, the supply elements are much greater. And I think to see that, all you need to do is look at vacancy to unemployment ratios or unemployment levels, and you need to look at various core measures of inflation in Europe, which are much more favorable and much more benign. I think the European monetary policy problem is fundamentally more complex than the American one, because I think it's clear when you have overheating that you're supposed to have done something about it. And it is less clear when you have increases in headline inflation, but not core inflation, what you should do, with the additional complexity being that it is plausible to believe that the feed-through into wage price cycles coming from increases in headline inflation is a more salient feature of European than of American labor markets. Hugh, I've always had trouble hearing relating to the 1946, 1949 thing. It seems to me that when you're taking price controls off and you're massively shifting production from producing armaments that don't do anything for consumers or traditional investors to producing goods and services, it's not very surprising that you'd see inflation go way up when you took price controls off, and then come back down when you didn't. So I don't find that hugely probative. I think there is an interesting question as to why the smart people were wrong in 1943. That is, if you were a if you were a thoughtful macroeconomist in 1943, what you were deathly afraid of was that when the war ended, we'd go back to secular stagnation and have another depression. And that did not happen. And why did it not happen is, I think, a really important question. Some of the answers are because nobody could buy a car or a house or build a car or a house for 5 years, so there was a huge pent-up investment demand. Some of the answer was that there was a huge spending demand because people accumulated assets because of the rationing. Some of it was that the country decided to build suburbs on a massive scale, and the fertility rate decided to go to 4 children per woman, which created all kinds of demand for all kinds of things. Some of it was that there was a massive set of public support for investment in housing. So I think there are answers to the question, but that's the question about inflation. And the other thing that I would say about it is, if you look at Uncle Paul's textbook, it's very interesting. In every edition after 1948, there's what you would take for granted today, which is a graph showing the evolution of the inflation rate over time. In the 1948 edition, there's a graph of the price level. And it says something about what the mindset was, that there was this price level, gold standard that was stable. So all of that says to me that the post-World War II experience is not very relevant. Martin, I knew you were going to do one of two things when you asked a question from long experience. You were either going to puncture a hole in my argument, or you were going to take my argument even further than I had taken it. And I have to say, frankly, I'm glad you chose the second course, knowing of your capacity to do the first. I think you're right to have the concern, and there's an additional line. Your argument was essentially, well, gosh, everybody's just going to be scared about everything, so they're going to want to hold a lot of the people are going to want to hold cash rather than have stuff, and the businesses are going to want to not buy stuff, and so the neutral rate is going to come way down. My younger and more mathematically rigorous colleagues are much taken with the following consideration that you might have mentioned, and I have not decided how important I think it is, but it reinforces what you said, which is we've just been through a period where everybody bought a new television and everybody bought a new appliance. And so after you've had a massive accumulation phase, then the stuff's there for a while and you can only have so many appliances. And so for a variety of demand categories, it may be that we're going to be a little bit glutted with them. And that would only operate to reinforce the considerations that you adduced. Yet another consideration that goes in this direction is that construction is half as large a share of the economy as it was 30 years ago. And it's construction which is most likely to be interest sensitive. And so if you have fewer and fewer interest sensitive sectors, it follows that when you have a given, say, investment savings gap, the magnitude of the decline in the interest rate that's necessary to close it has increased. So yes, I was becoming convinced before the massive stimulus episode. I was becoming convinced of the profundity of the secular stagnation problem around what I'm saying, plus a bit of a general sense of pessimism, but I think you're right in what you raised.
Okay, I'll take some questions at the top there. I'll take the woman who's right there next to the mic, and then the two over here.
Hi, thank you so much. My name is Zuza. I graduated from LSE a year ago. So Professor Sammers, you've looked into the high cost of bringing inflation down and the importance of humility, shying away from forward guidance. What do you think is left in the Fed's toolkit to bring inflation down? Are we going to be expecting almost a Volcker moment, or are we going to have inflation staying above 2% for a little while? I'm curious to see your view.
Okay.
Hi, I'm Ramin, an economics lecturer at UCL. You touched on this, but what's the implication of this new world for central banks' independence? Are they going to become more politically vulnerable in this new world?
Hi, Stefano, Morgan Stanley. I wanted to ask your opinion about the slow reaction of the ECB in hiking rates and whether this could have an impact on peripheral economy, maybe triggering also Eurozone stability.
I missed the last part of it.
Eurozone instability risk from
It's easy for me to say coming from away, but my instinct is that the ECB better figure out some really strong anti-fragmentation measures, because we really don't want to see the consequences of a world where regular monetary policy is constrained by the fragmentation considerations. So I think if we're going to have a monetary union, we're going to have to find a way of being able to adjust interest rates to where they need to go. I'm sorry, your question was about
bank independence.
Central bank independence. You know, I'm confused in the following sense. Prior to the 2021 excesses, my view was that the reason we had central bank independence was basically as a commitment problem to solve dynamic consistency. And that if we were living in a world with too little inflation rather than too much, that really wasn't that important a problem. And therefore, we probably had passed peak central bank independence. And that was probably, and that in some ultimate sense was probably okay, because there were a lot of things central banks were doing that intersected with political decision making, bailing people out, dealing with green things, making judgments that implicitly were about the allocation of capital, the set of issues involved in debt management policy, where treasuries and central banks are both deciding the maturity structure of the debt. So my view prior to that was that probably we were passing peak central bank independence and that was okay. In light of current rates of inflation, I am less certain of that view, but I have to say that it doesn't seem to me that central banks have used their independence particularly well to protect politicians by doing painful things that the politicians would not have done. So I suppose I would fall back to being for central bank independence around central banks with considerably narrower remits than they've achieved. And, you know, I always told my kids that how many extracurricular activities they could do and how many courses they could do depended upon how they were doing in their like core central courses and their responsibility. And I think there's some doctrine of that kind that applies to central banks, and maybe you don't get to take on global climate change when you're having double-digit inflation rates. Might be a useful bit of guidance for central banks. And you're...
Is it a Volcker moment?
Oh.
Or are we going to live with higher inflation?
Look, I don't know which. I could imagine that going either way. I'm not going to give you a firm prediction. I'll give you two remarks that you might find interesting and relevant. One is that with Judd Kramer, I have gone back and reconstructed the CPI going back to 1950, calculated in the way that it's calculated today, rather than calculated in the way that it was calculated at the time. If you do it that way, the magnitude of the Volcker disinflation is not that much greater, particularly if you use core CPI. The magnitude of the Volcker disinflation that was achieved is not hugely different than the magnitude of the disinflation that would be necessary to take core CPI down to 2% today. They're of comparable magnitude. A lot of those very high CPI figures that one always reads about in the late 70s and early 80s reflect the fact that at that time, the mortgage rate itself was an input to the CPI. The other thing is that it is interesting in general. One of the things that I have sort of learned over time is that we tend to think of crises as these monolithic events. And in fact, things tend to be more jagged during them than one recalls many years later. So for example, there were 4 bull markets of more than a third between 1929 and 1933 in the United States, and some similar proposition was true in the great bear market after the tech bubble collapsed. And if one looks at the great Volcker disinflation, in fact, there was a moment in 1980 when Volcker eased up quite substantially, and then inflation accelerated, and then he engaged in the actions for which he's justly revered. But even Volcker had a first false start towards a Volcker moment, was punished by the market, and then delivered the Volcker moment. And so I think that's relevant in thinking about what's likely to happen going forward, and is part of the reason why I was suggesting that secular stagflation was a significant risk.
Okay. I think you'll agree with me that listening to Larry, you always have to think really hard. You always learn something, and you end up seeing the world very differently afterwards. And I think I couldn't imagine a better tribute to Charles Goodhart and a better talk that is in the spirit of what the LSE represents, which is being a bit ornery, thinking hard, being a bit contrarian, looking at data, not being too ideological, and caring a lot about what it means for the world. So thank you very much, Larry. And